Welcome to Hit the Brakes, where we dive into the top stories, market trends, and ins and outs of the supply chain. No matter if you're tuning in from the cab of your truck, behind your desk, or on your daily commute, we're glad you're here and we're ready to serve you. Let's get this show on the road.
Hi, I'm Sarah Hefner with Fetch Freight. Thanks for joining us. During today's webinar, we'll look at forecasts for 2025 and how to utilize the trends we're seeing as you plan for your upcoming year. I'd like to introduce to you our panelists. We're so glad to have Tim Denoyer, Vice President and Senior Analyst with ACT Research. Tim is the lead analyst in ACT's transportation research effort and the primary author of the ACT Freight Forecast, which provides supply chain professionals with better visibility on the future of pricing and volume in transportation. Welcome, Tim. Next up, we have Brett Lankford. With experience at major 3PLs, he used that expertise in transportation at Conagra Brands, then at Campbell's, guiding their transportation strategy through the challenges of COVID. Now, as Fetch Freight's Director of Strategy, he has been pivotal in developing an exclusive AI-driven TMS, optimizing cost-efficient solutions for customers. Brett earned a MicroMasters in Supply Chain Management from MIT and an MBA from Auburn University. Welcome, Brett. Leading the conversation today is Mitchell Lewis, founder and president of Fetch Freight. Fetch is an organically grown, rising national brokerage. Mitchell took his experience from small to billion-dollar brokerages and his work ethic of going above and beyond to drive the success of Fetch Freight. This year, he was named Birmingham's top CEO, and Fetch was named one of the best places to work after not making a single layoff during the latest downturn in the market. Can we all agree, customers and carriers who are tuned in today, what a big deal that is given the market? His team brokers shipments for Fortune 500 shippers while tailoring local and regional deals for customers of all sizes. Under Mitchell's leadership, the Fetch team values strong relationships, innovative solutions, and exceeding expectations. Welcome, Mitchell, and thank you for leading today's conversation.
Thanks, Sarah, and thank you for everyone for joining us today. Brett, welcome. It's been about 10 minutes since I think I've seen you, so thanks for joining me. But Tim, thanks for joining us. Just grateful for your partnership and your willingness to join us each year for this forecast and to discuss and talk through this ever-changing freight market that we all live in. So thank you.
Thanks for having me.
Yes, sir. And we're ultimately here to review the 2025 truckload rate forecast. We'll focus on dry van for the most part, but hopeful that we can maybe talk on some other modes as well potentially, but touch on. But focus on the 25 dry van forecast. Before we get to the forecast, we want to take a look at the current supply and demand conditions and discuss how each of those will ultimately impact the 25 forecast. And on those topics, we'll focus heavily on the Class 8 truck orders, driver availability, potential impacts of tariffs and policy decisions. And then we'll also save some time for Q&A at the end. So just a quick reminder to everyone that if you have any questions throughout the discussion, please submit those through the chat feature, and we'll try to cover those at the very end. I will mention I've already had one question, and just to clarify the conversation, we'll be speaking about U.S. dollars as opposed to Canadian. I think that, just to clarify for some of our analysts who may be on the phone, this will be a focus on the U.S. dollar and North American transportation. So
we can hit on Canadian spot rates briefly, but yeah.
Okay, great. Okay, perfect. Awesome, thank you. So let's get to the next slide here. So we'll start off. We'll just jump right into the supply conditions for this chart right here. It really tells the story of the supply side during the downturn over the past 2 years, really. Which has been somewhat unique. You don't usually see such a high quantity of orders of Class 8 trucks in a down cycle, which we experienced over these past 2 years. So, Brett, do you mind jumping in and just telling us what you're seeing here?
Yeah, sure. I'll just start off by saying I love this graphic for helping tell the story of the history of what's really transpired during kind of the COVID Black Swan event, and it gives you a little bit of prior cycles, around 3 cycles here leading up to it, to kind of give you an idea of like what is quote unquote normal. And really, I mean, kind of like in line with everything else that we experienced at the onset of COVID, and even now continuing on the back end, that everything that we've experienced has been nothing but normal, or everything but normal, I should say. And really, I'll just to kind of start telling the story of what happened during COVID and where we are today, really kind of draw attention on this chart to 2020 through 2024. You can see basically, and let me start by this, of what is this chart that we're looking at? This is looking at Class 8 truck orders and the backlog that accumulates. Orders often outstrip production. So there's constantly this element of a backlog of orders that have been placed, waiting to hit the production lines and roll off of it. And when you really think about this, the capital expenditure that goes into investment in buying trucks and scaling up fleets usually follows demand. It usually follows a environment that's conducive to those new assets and those investments generating a return. So oftentimes you'll see demand pick up in freight, rates pick up, and that drives further investment. Think of the gold rush, and I really think COVID sort of was, in a way, sort of that gold rush, and that rates took off, and then money piled into the trucking sector to buy used trucks, buy new trucks as well. And that really generated a massive order queue. Now you think about some of the other themes during COVID, supply chain shortages sort of at large, and really what hit this market the hardest was the semiconductor shortage. And just a quick anecdote there, my time on the shipper side during COVID, we had a large asset company come to me and say, basically the question that they were being asked at the time by the OEMs and the dealers is, do you want power windows or not? If you're okay with crank windows, I can get you a truck some months sooner. And we're talking about, it could have been 12 to 18 months to get a truck back in those days. That's the length of the kind of the order queue. So there are some really interesting, I think, decisions business managers made on the trucking side. But really what has been unique, and we talk about why has the market stayed down so long after this, extreme slide coming off of COVID highs. I mean, we're going on roughly like 2 years now of a trough in rates, yet investment has maintained. And I think that's one thing I'll call out here. If you look at this chart, you see the big spike. I'm talking about the black line, the backlog, over the hump in 2021. And then you see more spikes in 2022 and 2023 that are very unusual. Even looking back at the last 3 cycles here, you continue to see investment be made. Even in a very challenging unit economic environment, rates were low, profitability was challenged. So that really kind of has been the story, is that there's been a lot of investment sort of as an anomaly during all of that. I know, Tim, you guys have done a great job of bringing forth what I feel like is a very opaque area of the trucking market, and that really is around private fleet investment. Y'all hit on this topic very large at your investor conference and the ACT Research Conference, and continues to be such a prominent storyline here with what's going on the Class 8 and on the supply side. You mind sharing, just for everybody here, just some of the things that y'all have learned and discovered through that? I feel like that is one of the big stories here.
Yeah, sure. Thanks. And that's a great setup for that's really what's going on. If you look at this chart, if you look at the cycles, they tend to be a good bit shorter, and this one's really kind of has extended out. And certainly we've come back down, and that does suggest rates are going to go higher. But we had this big extended backlog for a much longer period of time in the past few years, and you can see when you look at the for-hire fleets, they're not the ones who are adding a lot of capacity. For-hire fleets are shrinking. We know that. We know operating authorities are down. We can look at the big fleets. Their tractor counts are down about 6% year over year for the publicly traded for-hire truckload fleets. So who's buying the trucks? That's been the question of the past year or two, and it really is the private fleets who have been insourcing a lot of freight. I was actually on the DAT show earlier today, and we talked about this same issue where Dean talked about how some private fleets are really pushing the limits with their day cabs, and you can see it in our Class 8 data when you break down tractors between sleepers and day cabs. You can see day cabs have been rising, and that's sort of synonymous with private fleets, but private fleets can sleepers too, and they do, and they are, and that's that insourcing is happening in the biggest piece of the supply chain that is happening is actually the vendors going to the DCs. That used to be a very for hire move that's been insourced pretty aggressively in the past couple of years. You think about a good example of that would be Procter and Gamble, who didn't have any fleet at all until about 5 years ago, and now has a fairly sizable one. That's one example, but a lot of the big retailers have been adding to their private fleets as well in a pretty big way. And every time we think this is cooling off, we see numbers like the November Class 8 order numbers.
Right. No, I think it's great, Tim. That's just a great recap of what's been very interesting past couple of years here on the order front, and what looks to be continuing to be just all eyes on that in the coming weeks and months. And just keep an eye on just a reminder to us all of just how intertwined the order patterns are with the freight cycle itself and the rates inside the freight cycle. And traditionally they're very intertwined, but we've seen some anomalies over the past couple of years, and maybe it's a little bit different this go around as well. But no, thanks for just moving us, take us through the update on the Class 8 orders. But so this is the tractor rate, the Class 8 net orders and spot rates, and kind of see that correlation between the two. Tim, before we dive into how this is all impacting the rate cycle and what lies ahead for the Class 8 trucks, I think you're about to touch on it there, but you received some pretty interesting news recently that you kind of shared with me late yesterday afternoon about orders from last month. Can you tell us, what you're hearing about the orders from last month and some of the data that's coming out now?
Yeah, absolutely. We just put this the November final data out this morning, and we were pretty close there on our estimate. If you look at the if I direct you to the black line at the right side of this chart, we had right around 21,000 was the estimate. The actual November Class 8 tractor order number came in at 23,000, and so a couple thousand ahead of our expectations. I leaned a little bit towards straight trucks in my estimate because they've been so strong the last few months. But we got another pretty big Class 8 tractor order number in November. Now, there's certainly a number of reasons for this. We had seen a pretty tepid start to order season in September and October, which is what we would expect around ahead of an election. And then, after the election, you see just the reduced uncertainty allow some of those orders to flow, and that certainly happened. The question now going forward is really how much is this sustainable? One way to interpret this is that private fleets are suggesting these EPA rules are not likely to change, and that's the general industry consensus. We can get into that in more detail, but the pre-buying that's been going on over the past couple of years seems likely to continue. It is one takeaway from this. Certainly seems like Class 8 tractor sales are going to remain unusually high in 2025, which is going to have some muting effects on the rate cycle. But as you can see on this chart, we're seeing if you compare the real inflation adjusted spot rate relative to truck orders, it looks like truck orders are getting, the cart's getting ahead of the horse. And that's generally a concerning sign from a cyclical perspective. And I know there's a lot of people saying, rates are going to go up quite a bit this year, but this would argue otherwise.
Right. Yeah. No, I think this is something we're all going to keep our eye on for sure. Brett, do you want to maybe just hit on the, I think Tim was alluding to it, but some of the EPA regulations that may be driving some of this?
Yeah, no, and like just before that, Tim, I'm going to borrow a phrase from one of our conversations over the last few months. But, when you're using your words here, if you're trying to get out of a hole, you need to quit digging. And that's really been a theme throughout all of this. And, I know this is a busy chart, but I did want to make sure we showed that correlation of rates to the equipment purchases. And just kind of case in point, you can see the blue dotted line, the orange line, dropping off right as you're getting into 2022 here on this chart. That was the rates plummeting, the spot rates. But yet you see this huge spike there in 2022 of incremental orders. And it's really kind of continued. And the topic around what's happening with trucking capacity, I feel like really goes, you hear it mentioned a lot about motor carrier authority revocations, which is sort of like one of the few proxies out there for people to kind of get a pulse check on which way the wind's blowing, but it's not necessarily a fully transparent truth. I'll say that, somebody may shut down a trucking company, but go lease on somewhere. So, I feel like this is really helping tell the story of what's really happening on the supply side is that there's been continued investment. And kind of like you said, Tim, it seems like we're kind of getting maybe a little bit out in front of our skis, wishful thinking maybe on the investment front with this large order print that was in November here recently. And I think over the next 3 months, everybody's going to be waiting with bated breath to see what the next couple months of orders look like coming in. If this trend continues, I think this is where we're kind of projecting out from the right side of the chart of what to expect on this front. What happens over the next few months on truck orders, I really do think kind of can determine the trajectory for next year. So it's going to be very important to watch that. Now, Mitchell, you asked about EPA 27. I find this topic really interesting. We've recently obviously have a new incoming administration. Was 2 administrations ago, second Trump term. Now, if you go back to his first term, there were new emission regulations that the work began on that under the first Trump administration. So those have kind of maintained, have not really been touched since then. There's kind of eyes on what happens in 25 and 26. Does cold water get thrown on some of those emissions controls? There's no real indication that anybody's backing off. And I think this also is, like what Tim was alluding to, is leading into a lot of the capital expenditure decisions and investment decisions being made to go ahead and purchase emissions compliant trucks. And I think you'll see that trend continue most likely in 25 and 26, gearing up for that. And I think 26 is probably when I think the turbo thrusters kind of get put on for Class A truck orders, and making those acquisitions as close to time as possible. So I really do think that's a major storyline that's going to be kind of competing with sort of what's naturally already happening in the market. So you kind of have some regulatory pressures that could actually drive some supply decisions here that really could just kind of throw some more disruption into what to expect that the future will hold for us.
Yeah, that's a great setup. It's a huge coin toss right now. Is the bottom line with this? Like you said, this rule making process started under the first Trump administration. We're 5 years into a 7-year planning cycle. This thing goes live in just over 2 years from now. Yet, it's also worth pointing out that a bill last year made it all the way to President Biden's desk to repeal this rule. So it's already written, and it may not have so many roadblocks this time around. But we know some people, they're influential in Washington want higher diesel costs, like a certain Elon Musk, and so. That sort of argues that the rule goes, stays as it is. I think the industry in general has invested quite a lot in getting ready for this. The EPA 7, the Clean Truck Initiative, is really not that big of a change from a technology standpoint. It's going to make SCR systems work better, which is important, and it's going to warranty them closer to the full life of the truck, which seems reasonable. And truckers may protest these higher costs, and they may end up getting this bill to the president's desk and get this rule thrown out. It's possible, and that really could change the outlook for the cycle significantly if that happens. We just don't know.
That's, yeah. That's
But
all. That's
yeah,
also, I mean, obviously, this is something, a big thing that we're all going to keep an eye on in the coming
yeah,
weeks and months, and just kind of see where this is headed. But, I want to, it's like, there's so many different topics we need to cover today, but, we haven't really spent a whole lot of time quite yet just talking about driver availability. And, this is one of those slides or graphs that I think that, Tim, y'all do such a great job of covering this for us. And, just and Tim, please feel free to chime in if I get anything incorrect here. But, it's really just showing, driver availability is a loosening market, a tightening market. And as I understand it, you guys really look at that. The index hitting, 50 is kind of equilibrium there. And then the 45 to 40 range is when you really are considering it, the market to be tightening up a little bit. And right now it looks like we're in that 55, 56 maybe range in the most recent reading. But I think you mentioned that there's some pretty interesting data coming out right now that's really kind of raising some eyebrows, pointing to the Drug and Alcohol Clearinghouse 2 that went into effect in November. But can you kind of speak to that a little bit, Tim?
yeah, absolutely. One thing I'd add on the index is this is a monthly survey of mainly medium and large fleets that we've been doing for a long time, and so it gives that one perspective. It doesn't really tell you what's happening from a private fleet or owner operator perspective, but large for-hire fleets are the ones who we're talking to on a regular basis. But yeah, I think this has been certainly loose for a while. I think anyone not even sure ATA would argue that we have a driver shortage right now, and I think that it's turning though as we speak, and we've had a loose market now for quite some time. I think the Drug and Alcohol Clearinghouse 2 rule is significant. I think there were probably a number of states who were not enforcing it, who had to downgrade CDLs. I think there were some insurance companies who probably didn't notice that somebody had failed a drug test, but when they probably did notice when their CDL got downgraded. And one piece of evidence we have is just looking at the number of trucks that get posted on the spot market. And if you add up everything from drive-in, reefer, and flatbeds on the DAT load boards since November 18th through yesterday, so almost a month after this regulation actually got teeth, we've seen over a 20% drop in supply on the spot market, which is driving the load to truck ratio up significantly. And so we're seeing really positive leading indicators from a truckload spot market perspective. Now, this also may be one reason that fleets are buying a lot of trucks, because they kind of understand that there's some risks here, and so they're moving to address it. But I think that's an important part of the story, and I think there's not just the clearinghouse issue, but there's a lot of concern about some abuse of B1 visas around the Mexico border, and so there might be some increased enforcement around that's been talked about for a while now. I'm not sure if anything's really happening there. But one other factor to point out is the FMCSA is actually switching out motor carrier numbers to everyone's going to kind of go towards a US DOT number next year, which in theory should help remove some of the fraud and some of that excess churn that you were talking about, Brett, and the net revocations data. So that, I think, could tighten capacity a little bit as well. And of course, the threatened increase in deportations would press down on this index too.
Yeah.
Yeah, that's a good point, Tim. I'll just call it for the viewers and for those who maybe don't know, but the trucking market is heavily supported by immigrants. It's a very diverse population, so I think anything that comes out on the deportation front, and like you called out with potential challenges to visas that may possibly be looming, that's something to definitely keep an eye on. That I do think could heavily impact true driver availability. I'll mention one other thing just to keep an eye on. just kind of a truism is that construction and trucking often compete for some shared pot of labor. There's a lot of truck drivers who kind of go back and forth to whichever is the most fortuitous at the moment. So, construction heats up, they get to maybe work at job sites near home, can maybe even make more money. It's a totally different kind of lifestyle than being a long haul truck driver. But that there's an ebb and flow with some piece of the labor that supports the trucking industry that kind of migrates between those two industries, depending on kind of what is more favorable for them. So when we think about what's kind of been challenged over the last couple of years, high interest rates, mortgage rates have continued to climb, kind of actually stayed high, really even after some of these latest cuts from the Fed. But if construction begins to heat up, new housing starts, things of that nature, I do see some challenges potentially looming for the driver population, just in addition to the other things we've called out here today.
Mhm.
Perfect. All right. Well, thank y'all. I mean, it just goes to show we have so much to keep an eye on in the months and the year ahead. Drug and alcohol clearinghouse, immigration policy, deportation, the housing market, just a lot of things to keep our eyes on for now. So thank y'all for that. Moving on to the shipments, to the demand side of things. We know that consumer has been really extremely resilient in the past year. I think there's probably been a little bit of sentiment that maybe the economy has been down or whatever it might be, but especially if you're in logistics on the carrier brokerage side, it's felt that way. But at the end of the day, the consumer's been very resilient. And 2025, still have a lot of intrigue out there on the demand front. Tim, I'll just open it wide open here. What are you anticipating in terms of volumes? What's going to happen in 2025?
Sure. Yeah. It's a important side of the equation. We're seeing some generally improving trends from a retail sales perspective. I would say retail sales have been below trend for the last couple of years. We went through that downturn in 2022. We got back to some slow growth in the second half of 23, and we've been growing 2 or 3% or so for basically the last year if you just look at overall U.S. retail sales. So that trend is improving, but the long-term trend is 3 or 4%. So we're still below that, and I think we're heading towards it. And so I think there's some upside there. We're a little bit more cautious on the industrial side. As Brett talked about, the interest rates have backed up again recently, which is probably not the best news for some of those durable goods and some of that more industrial freight. But the retail and more non-durable goods side of the equation is still kind of below trend and getting back towards trend. So that's
can I just jump in real quick, just highlight that for you? I think we've talked about it, but again, we've heard all these stories of these rate cuts, but at the end of the day, that has not impacted the 30-year mortgage rate. It's actually kind of gone the opposite direction since we've been experiencing these rate cuts. So I think that's what I think it's important for us not gloss over that, because I think a lot of us are every time we hear a rate cut, we get excited, but it's not really flowing through to the consumers, at least on the housing side of the market. But sorry, I'll let you keep going. But
it's a great point. It's a considerable concern for demand, broadly speaking, as we look at next year. Probably the biggest concern that we have is some of the new administration's policies are inflationary. Deportations, taking out labor supply, that's inflationary. Tariffs are literally taxes. Those are inflationary. They're going to push prices up. And all of that is going to reduce the Fed's ability to cut rates. And whereas I think some people were expecting some significant rate cuts next year, those are being reconsidered at the moment. We do think there's another 25 basis points likely coming this week, but we're not too sure beyond that. And if we look at the outlook for the for-hire sector in particular, we've got some decent growth expected in the cash freight index here in 2025, but a lot of that expectation is pre-tariff shipping, is to get ahead of the threatened tariffs. It makes all the sense in the world for shippers to build safety stocks right now to try to manage around these tariffs. You're obviously not going to be able to build 4 years worth of safety stocks, but there's a lot of changes coming, of course. But But one of the bigger messages as well is that private fleets have been one of the main reasons that we've seen such a soft for hire cycle so far, is that there's been this insourcing going on into private fleets that it's been pushing down on the cash rate index. Now, all that said, the most recent November numbers for cash were only down 0.7% year over year, so it's getting pretty close to flat. And we do think it's getting ready to turn positive here in the next few months as imports are going to likely remain very strong.
Yeah, Tim, let me jump in really quick. I just want to call out one thing just on this chart. These last 2 years, 25 and 26, the orange, that's the forecast. And just the talk around the tariffs, and, we'll throw around a term called pre-buying. There's business response in advance of actual tariffs being levied, your incremental tariffs, that is, that they're going ahead and basically hedging against the risk of those tariffs by going ahead and bringing inventory in. I think we're already starting to feel that a little bit, but just to kind of help explain some of what we're seeing on this chart, you see a pretty drastic spike there in roughly Q1 of 25, where it really legs up on demand. And I think the other really important thing is, well, look at what happens, at least in this forecast of at the end of 25 and beginning of 26, you have kind of like a steep drop. And really, like in our conversations kind of leading up to this, there's an element of if you're going to go ahead and pull this demand ahead, these shipments and this inventory ahead, you've got to pay the piper at some point. You're robbing Peter to pay Paul. So at some point, you do have to kind of catch up and normalize your inventories. So I think the tariff story, and it's really hard to predict what is actually going to happen. It's hard to predict what the true business response is, even to get in front of these tariffs. You kind of know it when it happens. You know it when you start to see it and see it come through the data. But I think this storyline really is kind of one of the most important things going on in freight and really driving this forecast as well. And you hear about all the this kind of consensus now, the market call for 25 to be a stronger year on freight, and pretty much everyone is pointing back to this subject, demand and demand stimulation in 25 is it's kind of being one of the big precursors of that and big underpinnings.
That's absolutely. It's pre-tariff activity, pre-buys have paybacks is one simple way to say it. And I also think a bit of the 2026 downturn is likely going to be because of those regulations that we talked about earlier, and some additional insourcing around that, which is not likely going to be good for the for-hire sector, even though we expect the economy to continue to grow pretty well.
Mitchell, I want to add just one last thing really quick. But, if you're a transportation manager or a fleet manager, trying to take all this information that's at really just the macro level and distill it down into, well, where might you feel some of this or experience this demand and some of the changes that we're talking about? Obviously, one thing is, the ports on the West Coast and really ports at large, but all of this tariff pre-buying and importing is really going to drive what we believe is some very significant demand inbound into California through the ports. And one other thing, you hear the topic of nearshoring mentioned a lot. And I know Mexico's sort of gotten caught in the media headline crossfire of potential looming tariffs as well. But we've already seen a lot of that investment start to shift from Asia back into Mexico for production nearshore, and that volume has to cross the southern border. So we definitely expect that the southern border, that trend of heating up on demand there, to continue throughout this. So and I will just say too, the trucking fleets that are going to go and take advantage of this demand are also repositioning their equipment to capture that opportunity. There's going to be disruption in other markets that results from this. So I would just kind of call out some of those things to keep an eye on, is that inbound California imports and then cross-border Mexico to U.S. We believe is going to be extremely strong for the foreseeable future.
Yeah, it's worth also throwing one more point about the likely port strike in as well. At this point, it does look like January 15th is going to be another East Coast port strike. it's hard to say how long it's going to last. It's very hard to see the outgoing administration doing anything about it. And so, we shall see. This is something that is likely to be disruptive. There's probably going to be a surge of freight into those East Coast ports ahead of that, in the next few weeks. But then some avoidance, of course. You don't want to get stuck around that, especially because it could go a bit longer than the earlier one.
Right.
Tim, didn't you mention something along the lines of every day of a port disruption leads to roughly like 7 to 9 days of
6 or 7, I think is the rule of
like
thumb. Yeah.
operation disruption. So I think that's a really interesting thing. The length of these strikes really will determine the severity and the impact. It could be something that's a day, or it could drag on. So, I think just continue with the theme. We've got a lot of storylines that are really exciting here over the next year to keep our eyes on.
Absolutely. Thanks, guys. I think y'all have already recapped everything for me, but tariffs, throughout all of 25, we'll keep our eyes on that front and into 26. The ILA port strike is going to be another big driver. And then last thing, it's this shipment forecast is not going to be equal for everyone or all regions. It's going to be the Texas, and West Coast, and it's going to be distributed across the country differently. So be another fun year for us, I'm sure. So with that, let's get into the fun thing here with the forecast.